This is a BC Eagle Finance video. Brigham and Houston Chapter 2, Financial Markets and Financial Institutions. This chapter has 5 sections to it. The first section deals with the process of capital allocation itself, how people who have cash and want to invest it for a return can associate with folks that need the cash and are willing to pay that return in exchange for receiving the cash. That's all done in the financial markets, and there are different types of financial markets that this type of transfer can take place. The chapter also discusses the types of financial institutions, many of them that you and I use, like banks, work as financial intermediaries between those that have cash and those that want to use cash. The fourth item in the chapter will review a little bit of what kind of returns investors will receive and borrowers or users of capital would have to pay over time. And finally, the chapter introduces this concept of market efficiency. What does it mean, and what kind of strategy can you and I use as investors in this process? First up, what type of money really is out there? The largest part of long-term money does come from borrowing. And as a matter of fact, this is a breakdown of the size of the United States bond market. And as you can see, 3 elements make up about 75% of the bond market. And by the way, the bond market makes up about 2 out of every $3 in the capital markets. You'll have some treasury notes. You'll have mortgage-related type securities, the types of mortgage that's on the houses that your parents and anyone else that has a home will incur. And finally, you have corporate debt. The large corporations borrow money to buy new assets or other companies, and these 3 entities comprise about 3 out of every $4 in the bond market. The rest of the bond market is comprised of municipal bonds, some asset-backed securities, money markets, which represent short-term debt obligations that would be shown on the current liability side of the balance sheet, and finally, there are some federal agency securities that make up the remaining part of the borrowing. This is the outline of the chapter that you have in your texts. It reviews the capital allocation process, the financial markets, the financial institutions, a little bit about the stock market, and the physical location of the stock exchanges in the over-the-counter market, also known as the NASDAQ stock market, the National Association of Security Dealers Automated Quotes. We'll look at the market for the common stock, the type of returns the stock market has, and we will review market efficiency. And under the market efficiency, you'll see that the psychologist can come into play here with the behavioral finance theory and what we as investors can do to address this idea of market efficiency. Okay, how is capital transferred between savers and borrowers? 3 main ways. One is a direct transfer, where you have an individual or an institution that has money to invest, and that money goes directly to the user. Second is the investment bank function. This is where you have an initial public offering of either bonds or stocks, and the investment banker works as a financial intermediary between those that have cash and want to invest and those that want to use that cash for corporate purposes. And finally, you have the financial intermediaries that you and I use, the banking system. where you have the collective public depositing funds in a bank, and the bank indirectly takes that money and loans it to folks that want to buy houses, cars, or business assets. Let's take a little closer look at the three ways this transfer happens. First is the direct transfer of funds. So you have a business like KKR or Bain Capital, or you can think of the folks that are on the TV show Shark Tank. They are wealthy individuals that have excess cash that are willing to directly use that cash to help out other businesses. So they transfer that cash for either ownership rights or lending rights to the folks that want to use that cash. That's known as a direct transfer. The second is an indirect transfer where you have what's called marketable securities. These would either be bonds or stock that the business unit that wants to spend cash delivers to savers in exchange for the cash that they have. This process is the most frequently used, and it's known as an initial public offering. The third way capital is transferred is through indirect transfer through financial intermediaries. This diagram also shows marketable securities, but in this case those marketable securities would be in the form of bank deposits, savings deposits, and other banking institution vehicles. You have the collective savers, you and I and the person down the street that puts money into savings and checking accounts. The bank then will loan that money to individuals and businesses that want to use it to invest in hard assets like cars, trucks, mortgages, houses, and business assets. So there you have it. A direct transfer, an indirect transfer through an initial public offering, and then the multitude of transactions that happen through financial intermediaries like banks. Next up in the capital allocation process is the idea that in a well-functioning economy, capital flows efficiently from those who supply capital, savers, to those who demand it. Those are the ones that want to invest that cash. And here is a diagram that looks very familiar to you. You have the excess cash, and this represents the amount of cash that would be available depending on the rate of return, the interest rate for that particular cash. On the other hand, you have the demand for that cash by those that want to use the cash to buy assets. And as the interest rate is very high, the amount of cash demanded for use is very low. As the interest rate drops, you can see that the amount of cash demanded is very high. And in that case, there would be an excess of demand over the supply. So the interest rate represents the adjusting mechanism, and where the amount of return that the savers would want to have to part with their company equals the amount that investors are willing to pay for that cash, you have equilibrium, and in that case the level of supply of cash equals the amount of cash that's available for investment. So suppliers of capital are individuals and institutions that have excess funds, cash, that they can put into the system, and these groups are savers and are looking for a rate of return on their cash. The second group would be the users of capital, and that would be you or I or the institution down the street that want to raise funds to finance either personal assets, a car or a house, or business assets, a plant or even another business to invest in. Now it's your turn to test your understanding of the capital allocation process. We have some questions for you to review, and reading the textbook would be a good idea to do before tackling these questions. Number 1 is to name the 3 ways capital is transferred between savers and borrowers. Second question, why are efficient capital markets necessary for economic growth? The content of this chapter will continue in another BC Eagle video.